Are you confused by the ever-changing market cycles? Don't worry, you're not alone. Today, we'll break down three distinct market regime indicators and show you how these trading filters can help you. We look at three specific market regime indicators, and you can see their performance on the screen: the Fabian market timing model, the Coppock curve, and the 200-day moving average. We go straight at it and present you the Fabian timing model. Developed in the 1960s by Richard Fabian, the Fabian timing model isn't your average gut feeling-based strategy. Instead, it leverages the power of numbers and averages to guide your S&P 500 trades. Here's the idea behind it. The model tracks the movements of three key players: the S&P 500, the Dow Jones Industrial Average, and the utilities sector. When these three giants dance in sync, the model identifies a buying opportunity for the S&P 500. But if two or more start to buck the trend, it flags a potential sell signal. The Fabian timing model listens to all three averages and tells you when to act based on their consensus. Let's summarize the trading rules for the Fabian market timing model. Buy when the S&P 500, the Dow Jones Industrial Average, and the utilities sector are all above their respective 39-week moving averages. Sell SPY if two or more of the indices are trading under their respective 39-week moving average. Let's backtest it from year 2000 by using the ETF that tracks S&P 500, SPY. While this isn't a get-rich-quick scheme, the results are impressive. The Fabian market timing indicator bested a simple buy-and-hold strategy by 2% annually, even though it was only invested in the market for 56% of the time. This is a long-term game built on discipline and patience. It won't make you an overnight millionaire, but it could boost your returns over time. If you want to find out more about the strategy, please check out our website quantifiedstrategies.com or the linked article in the description. Let's go to our second strategy, which is based on the Coppock curve. Invented by economist Edwin Coppock, the Coppock curve strategy is a regime indicator for spotting long-term trends. How does it work? This curve isn't drawn by subjective trend lines. It's calculated using mathematical formulas to create a market regime filter. Think of it as a compass guiding you through market cycles, telling you when to buy and sell. The trading rules are simple. Buy when the curve rises above its 10-month moving average, and sell when the curve dips below the average. We backtested the Coppock curve indicator on the S&P 500 from 1960 until today. While the average annual return is slightly lower than the market, 6.1% versus 7%, we need to look at the risk and drawdowns. We see a significantly lower maximum drawdown of 30% compared to 52% for buy and hold, meaning you ride bumps smoother. Also, when factoring in risk, the Coppock curve actually boasts a higher risk-adjusted return of 8.2% versus 7%. Let's go to the third market regime indicator. It's by far the easiest one, and it has worked remarkably well. It's called the 200-day moving average timing indicator. Paul Tudor Jones, a legendary investor, swears by the 200-day moving average. Let's find out why Tudor Jones likes this market regime indicator and filter. Let's show you an example of the 200-day filter. It lags behind the price, but you need to think of it like a slow-moving train catching up to a speeding car. That's why it's called a lagging indicator. But here's the catch. While it might not be the first to react to every price movement, it offers a broader perspective. It smooths out the noise and helps us identify the bigger picture, the overall trend which lets you time the market. Now, those zigzags you see when the price goes sideways? Those are called whipsaws, and they're a common issue with all moving averages. The key lies in understanding why someone like Paul Tudor Jones still uses the 200-day for market timing, even with its limitations and zigzags. Let's dive into his reasoning and see how it can benefit us. We buy when S&P 500 crosses above its 200-day moving average, and we sell when it ends below the average. The indicator is simple but smart. While the average annual return since 1960 might seem slightly lower than buy and hold at 6.75% versus 7%, Here's the kicker. You get a smoother ride because it boasts a significantly lower maximum drawdown of only 28%, while buy and hold has 56%. By sidestepping some major bear markets, you protect your capital, giving your investments a better chance to weather the storms and compound from a higher level when the dust settles. By staying out of the market during certain periods, you reduce your exposure to big downturns. Remember, it's about smart investing, not just blind returns. Imagine dodging the 2008 crash entirely. That's the power of this indicator. Take a look at the chart. See how we exited the market in late 2007, avoiding the 55% plunge. By using the 200-day moving average, we identified the shift and stepped aside. When the dust settled, we re-entered in 2009, ready to compound from a higher base. Even considering many whipsaws, this market regime indicator has performed very well. That's the essence of Paul Tudor Jones's approach. Using the 200-day average as a simple but powerful market regime indicator. Above the line, it's a potential bull market. Below, it's a bear market. Remember, complexity doesn't equal success in trading and investing. Sometimes simplicity shines. Today, we have now shown you 3 market regime indicators, and we hope you liked it. Please like and subscribe to help us grow so we can make more videos like this.